Okay, let's unpack this. When you hear phrases like compliant digital assets or bank-ready blockchain infrastructure, where does your mind usually go?
Probably Wall Street, right? Maybe Silicon Valley.
Exactly. Almost certainly not your local federally insured credit union. And yet that seems to be exactly where some of the most, significant compliance-driven innovation in this space is actually landing.
It's quite a shift.
It is. So today we're doing a critical deep dive. Our mission, really, is to look at the sources focusing on Marshall Hayner's upcoming talk. He's speaking at the GOAS Credit Union Association's HAM-XX conference.
Right, the Metallica CEO.
That's the one. We need to figure out what credit unions across the country need to know now about stablecoins, not as, speculative things, but as actual financial infrastructure, critical future-proofing stuff.
Yeah, and the timing is key here.
The fact that we're seeing someone like Hayner, known for building specifically compliant digital asset infrastructure, talking to this audience, credit unions, which are typically quite conservative, very community-focused,
it tells you something's changed.
it really does. It signals the conversation has fundamentally shifted. It's gone from, abstract ideas to immediate operational strategy.
And what's fascinating, too, is the title of his session they've highlighted. Stablecoins on the horizon. What credit unions need to know now. That now is doing a lot of work there.
Definitely. It screams urgency.
It does.
Yeah.
This isn't some forecast for, say, 2030. It feels more like an operational briefing for, maybe even late 2024. So for you listening, the signal seems pretty clear. This isn't just a future curiosity anymore. It's become a critical, immediate topic if these institutions want to, future-proof their operations and maybe more importantly, stay relevant to their members.
So we need to cut through some of the noise, maybe define the specific tech rails, this bank-ready blockchain idea that makes this move actually safe and maybe even profitable for regulated places like credit unions.
Precisely.
Okay, so our sources are calling this a pivotal moment. We hear that phrase thrown around quite a bit. But what makes this specific combination, stablecoins and credit unions, feel genuinely urgent? Why now?
I think the urgency comes down to two main things. First, member service expectations are just different now. And second, there are real institutional operational bottlenecks, especially around liquidity management.
Okay, unpack that a bit. Member expectations. You mean speed, convenience.
Yeah, exactly. Modern members expect instant access, 24/7 service. But credit unions often still rely on older payment rails, things like ACH.
It's run in batches, right? Lots of delays.
Right. Significant delay, friction. And this isn't just about, say, faster international payments. It's about things like, credit union lending, settling checks faster, managing capital efficiently, like around the clock.
Okay, so if I'm running a credit union, the pain point isn't just my app feeling a bit slow, and the actual cost of having capital tied up because settlement takes too long.
That's a big part of it.
So if I can move funds instantly 200/4/7, I improve my liquidity. That makes sense. But historically, when credit unions adopted new tech, it was often just kind of rebranded middleware from their core banking provider. What's the concrete difference the blockchain part brings? What does it offer that a standard centralized instant payment system doesn't already?
That is the critical question, isn't it? And the core difference lies in the tokenized representation of the asset itself, the stablecoin, or maybe a tokenized deposit combined with the nature of the ledger, even if it's a private permissioned ledger.
How so?
Well, a centralized instant payment system is still fundamentally subject to the business hours and the counterparty risk of whoever is operating it. A single point of failure? Potentially.
Right.
A compliant blockchain, though, offers cryptographic assurance of the transaction, near-instant finality, and crucially, an immutable, auditable trail. And that trail can be standardized across potentially dozens, maybe hundreds of institutions using the same network.
Ah, okay. So greater resilience, more transparency than the old systems.
Much more. And this transition, as you mentioned earlier, it absolutely has to be anchored in regulatory certainty. It needs to be compliant.
Yeah.
Marshall Hayner's reputation, according to the sources, is specifically built on combining that innovation with a forward-thinking approach to compliance. And that's key here.
Why is that so critical for this specific move?
Because it ensures that the technology stack being introduced isn't some sort of risky pilot program. It's framed as institutional-grade infrastructure designed from the ground up to fit, ideally, within existing, often conservative regulatory boundaries.
So it's about building something that auditors can actually examine and hopefully approve.
Exactly. Digital products that are compliant by design.
That makes perfect sense. Okay, so we've got the urgency, the need for compliance, but Let's move past the phrase bank ready. How does the actual architecture, the tech, earn that title? Let's get into the specifics of the infrastructure Metallicus is providing here.
Right. So the core infrastructure revolves around what Metallicus is calling the digital banking network. It sounds like this entire ecosystem is specifically engineered to kind of bridge traditional finance with these new blockchain capabilities.
Okay.
And the underlying tech foundation, it's powered by two things mentioned, the Metal blockchain and the XPR network. These aren't just off-the-shelf chains. They sound like custom-built rails specifically designed to let financial institutions tokenize assets and move value.
Without leaving a regulated, audited environment.
That seems to be the goal, yes.
Okay, so it's not just a single blockchain. It's more like an interconnected system built for these institutional needs. If we drill down into the specifics, what are maybe the top, say, 3 features of this digital banking network that genuinely empower a credit union? How can they operate differently tomorrow compared to today using this?
Well, the features highlighted all seem to center on control and compliance. First, and this seems really significant, they're empowered to issue their own branded stablecoins.
Their own brand, not just using USDC or something.
Exactly. That's the key point. They aren't just relying on a third-party issuer. They can, theoretically, issue an institutionally branded, fully reserved digital liability that's tied directly to their own member deposits.
That branding aspect feels important for trust, right? Especially with credit union numbers.
Absolutely. It potentially translates that existing member trust directly into this new digital realm. So that's number one.
Okay, what's second?
Secondly, they can deploy private subnets. Now, this addresses your earlier point about why they might need a blockchain versus just a faster centralized rail. A private subnet is essentially like a permissioned version of the blockchain.
So only authorized players allowed.
Precisely. Reserved only for authorized financial partners. It creates a controlled, institutional-grade environment where, crucially, every transaction can be inherently auditable by regulators and linked back to a verified KYC CAML compliant identity.
Okay, so you get the efficiency benefits of blockchain.
Without the anonymity risk often associated with public chains. That's the idea.
Got it. That is a crucial distinction. The private subnet allows for that inherent on-chain compliance. Makes sense. What's the third feature? And how does that maybe connect to the wider crypto world, if at all?
The third feature mentioned is the ability to connect seamlessly into a compliant DeFi ecosystem. And again, that modifier compliant DeFi is absolutely critical. It's the non-negotiable part for traditional finance.
Right. DeFi can sound like the Wild West sometimes. So compliant DeFi means?
It means leveraging some of the principles of decentralized finance, like automated settlement, using smart contracts, but requiring all participants and all assets involved to adhere to strict know your customer and anti-money laundering checks.
Okay, so it's merging the efficiency of DeFi protocols, potentially.
With the strict regulatory structure and oversight of traditional banking. And this is where those liquidity management benefits we talked about earlier could really kick in. It might enable things like institutional-grade lending or asset pooling, but without adding unnecessary counterparty friction or regulatory risk.
So putting it all together, the overall objective of this digital banking network seems pretty clear then. It's designed to provide the specific tools, the institutional tools needed to help credit unions safely navigate this next phase of financial tech.
Yeah, it's about giving them control, giving them sovereignty over their digital assets within a compliant framework.
Right.
Absolutely. So, okay, we've talked infrastructure. Let's maybe move past that and try to synthesize the specific actionable applications that credit unions are apparently exploring right now based on the source material.
Good idea. What are they actually doing with this tech?
Well, we see 2 primary areas mentioned where this blockchain capability seems to directly integrate with member services and internal operations.
Okay.
The first one is leveraging this secure ledger technology for enhanced digital identity.
Digital ID. What does that mean in practice for me as a member?
Well, think about it. Today, verifying your identity online, even with your own bank or credit union, can be, well, siloed and often annoying, right? Multiple login security questions. By using blockchain for identity, the idea is that credit unions could potentially help create highly secure, maybe even member-owned digital credentials. This could drastically improve verification processes, maybe reduce fraud risk significantly.
And make the whole experience smoother for the member, enhancing engagement.
Exactly. That seems to be the goal. Making interactions faster, more secure, maybe more seamless across different platforms or services offered by the credit union.
Okay, that makes sense. It ties directly back to enhancing member engagement and the second major application. I assume it relates back to the money itself?
It does. It's the foundation of this whole discussion, really. Tokenized deposits.
Right. Give us the simple definition and the key operational benefit again.
Okay, simply put, tokenized deposits are just the representation of traditional regulated deposits like the cash you have in your credit union account, represented as a token on a compliant blockchain ledger.
And the operational benefit.
It's massive, and it comes right back to that liquidity point. If you have, say, $100 sitting in a legacy system, moving that money, settling it, takes hours, maybe days via ACH.
Yeah.
If that same $100 is represented as a tokenized deposit on one of these compliant blockchains, that value transfer, that settlement can happen in near real time, 24/7, 365.
And that 247 instant settlement is the engine then. That's what drives the improved liquidity management.
Precisely.
Instead of needing to pre-fund accounts for weekend activity or wait for batch processing Monday morning, the money is effectively available instantly across the network whenever it's needed.
That's the potential, yes. It connects the ledger technology directly to tangible business outcomes, better capital efficiency, potentially lower operational costs, and easier regulatory reporting, perhaps.
Makes sense.
And, the visual representation mentioned in the sources really reinforces this institutional focus. There's imagery described showing America's cooperatives, the credit unions connecting via these digital banking rails directly to the metal blockchain and the XPR network.
So it's not abstract, it's showing the connection.
Exactly. The message seems to be, these aren't theoretical anymore. These are specifically compliant, institutional-grade digital banking rails. It really confirms the idea that this tech is designed to be a durable bridge, taking that trusted, cooperative model of traditional finance.
And layering secure, modern blockchain capabilities on top, making it ready for potentially wider adoption.
That appears to be the core message, ready for institutional use.
Okay.
So maybe to wrap up the key takeaway from this deep dive, it looks like the integration of stablecoins, alongside things like enhanced digital identity and tokenized deposits, is genuinely underway, and it's happening within the traditionally conservative world of credit unions.
Which is the surprising part.
It is, and this shift isn't being built on, say, speculative open-source public chains. It seems to be powered by specific, vetted, compliant technologies like this digital banking network. Technologies explicitly designed to future-proof these institutions while respecting the existing regulatory landscape.
So the convergence is happening now, and it's packaged specifically for them.
That's what the sources suggest. It's packaged for institutional use.
All right. And that leads us perfectly into our final provocative thought for you, the listener, to consider. Given that this entire focus, especially around Metallicus and Hainer, seems centered on compliance and innovation, what regulatory step do you think will be the single biggest trigger?
Good question.
Nationally or internationally, what single change could spark mass adoption of these branded stablecoins by traditional financial institutions like credit unions? Will it be clearer guidance from, say, the OCC on custody, maybe an explicit regulatory sandbox from Congress?
Or maybe an international agreement on reserve standards.
Could be, or something else entirely. What specific change do you think holds the biggest potential to really unlock this and truly enhance member engagement using this new compliant tech stack? Something to think about as you watch this space evolve.